And now, with Sound Investing, here's Paul Merriman.
Well, we've got a special presentation today. Chris Pedersen, our Director of Research, came out with what I thought is just a terrific article in the American Association of Individual Investors Journal. And I'm not the only one who thought it was terrific, because they chose to put the title of that article middle of the page in as big a letters as you could possibly get. And that title, it's long. I love it because I love titles that make me think that something's possible without breaking a leg. So double your lifetime purchasing power in 20 minutes. Double your lifetime purchasing power in 20 minutes. That's a big statement. I've used 101 decisions to change your financial future. The difference in my case is I don't make any claim that it's going to be better. I just hope it'll be better. But I think what's in this article, Chris, is about a better future for a whole bunch of investors. So I know you've got some PowerPoints. I would love to see them. I'm going to try to be mostly a listener, but I've seen the PowerPoints. I've got a few questions. I've read the article a couple times. It's one of those articles. There's so much in it that I think it takes a couple of reads to get everything from it. And we, by the way, are going to have a link to the AAII website where you will be able to get it. You'll have to give them your email address, but we've tested this, and it turns out that when you click under journal, and then you'll see the October journal, and we'll take you there with a link so that all you'll have to do is type your name in, your email address. So, Chris, get us started here. Tell us where did this article come from, and really, are you serious? It's 20 minutes, or is this just to get my attention?
I am serious. It's 20 minutes, and I wrote it. I wrote it a year and a half ago, and it took until this year actually to finish it and publish it. And I wanted to publish it in the fall because I think that it really pertains to people who are doing open enrollment, especially if they have an employer-provided 401k program. And the gist of the story is that for somebody who invests in the defaults of the 401k program that are most typical across the industry, and they do that for 40 years of their career, and then they do fixed 4% withdrawals in retirement, and you look at all the cash flows in and the cash flows out and the standard investment, which is a target date fund, and then you adjust for inflation and you say, well, what was the impact on how much they have to spend over a lifetime? Mm-hmm. It doubles their spending power, even adjusting for inflation, just investing in a target date fund, which is kind of unbelievable. I when I first ran those numbers, I thought that's just not possible. And so I wanted to explain the story and explain how people might even do a little bit better. And I know that the article begs some questions and there's some opportunities for clarification. And yes, I do have some PowerPoints, but we'll try and use words here that explain it for people on a podcast out for a walk so that they can get value out of it without that. So I'm going to start sharing this PowerPoint, and let's make this as interactive as we can, because I think it'll be more fun. And sometimes I go too fast anyway, so you can slow me down. So the title of the article was Double Your Lifetime Purchasing Power in 20 Minutes. And part of what powers this is what has happened to retirement portfolios over the last 20 years. Basically, because of target date funds, what you see is that in 2005, if you looked at the average investor in a 401k, they only had about 55% of their investment in equities, and the rest was in fixed income. And we know that for a young investor, it makes sense that they can take more risk because they have more time for compounding to work for them and more time to work. But I think the truth is most 25-year-olds signing up for a retirement plan they're not educated about investing. We don't do that very well in school. And so they want to be diversified, and they look at all these choices and they say, well, I'll take a little of this and a little of this and a little of this and a little of this, and I'll be diversified. And what they don't realize is that by holding a high percentage in bonds, that's going to reduce their long-term likelihood of success because it reduces their potential return substantially. So with the introduction of target date funds, people get defaulted into something that is more appropriate. And now what you see in 2021 is that the average investor in a 401k has close to a 90% allocation to equities. So it's dramatically changed. And what I wanted to see is, well, with this significant improvement in their expected return, it turns out this is like 2 to 3% across their accumulation years of expected return increase. What would their experience be? And so I ran the numbers, and to run the numbers, I had to make assumptions. And so the assumptions I made were, I looked at, well, what's the median salary in the United States? It's $68,000 a year. Well, if somebody took the typical default program that they would have in a 401k, it would start them out, it would default them to start saving at 3% of that salary, which is $2,040.
Could I ask right there, Chris, about this median salary of 68,000?
Yeah.
That it looks very similar to a number I have seen for college graduates at age 25. Or is that what this is?
I think it's the median U.S. household salary. So it's probably high for a high school graduate, and it's probably typical for a college graduate. So yeah, that's a good point. I took the median household salary, which is probably more typical of mid-career. I think since we're going to focus on purchasing power multipliers, the actual dollar amount doesn't matter as much, because if you lowered these numbers all by a factor of 2, the multipliers would stay the same. But continuing on, then the default would be you'd start at 3% and you'd get a 50% employer match, which would be $1,020 for a total of $3,060 in year one. And the automatic default for most programs is that contribution amount will increase by 1% per year. So you start with 3% in year one, then you go to 4% and 5% and 6%. And the match typically maxes out at $3,000 per year. So I've got a table here that shows how that plays out, but you start out in year one with a total contribution of $3,060, and then it ramps up till in year 8, you've got a total contribution of $9,800, and that $9,800 then stays constant until you retire, as long as you're working.
Now, you have mentioned this several times now, that this is the most common automatic 401k combination of how much, where they put you, I guess, and how much they're going to put in. Did you actually see a number of how many plans have this built in, or is it just generally known that this is the most common default automatic 401k setting?
I took this there's a Vanguard report called How America Saves that they publish, and I took this out of the most recent Vanguard report. And so these were the most common, and I would say that this is probably about half of people who have an employer match 401k plan would see this sort of experience. Some people might see something a little bit better, a little bit worse. Some people won't have a default. Some people might have to make all these choices on their own. But I thought if I'm modeling something, I'll just pick the one that is the most common. Yeah. So what happens if you follow this plan? That's kind of the next question. And you ask a question. I'm going to follow up on the next page with well if we didn't inflation adjust it, what does it look like? I wanted to look at the real purchasing power. I wanted to look at the inflation adjusted dollars, and I'll show you why in a second. But the reason I wanted to look at the inflation adjusted dollars is that I want to know how much your purchasing power changes. So how much do you get to buy with the money that's invested, not just how big did the account get. So we'll look at it both ways. But if we look in the working years at somebody who just is a spendthrift, they don't save anything. They basically have the dollars they made to spend. You get your dollars, you spend some of it on taxes. That is a spend. You spend it on taxes. It may not be a choice, but you spend it. And then you get the rest. So the baseline assumption would be you spend everything you made. And that would be a lifetime purchasing power multiplier of 1. You made a certain amount of money and you spent it all. So you got a lifetime purchasing power of 1. But if you look at somebody who saves this roughly 10% into a target date fund, so that's the top of this bar, and you look at how much it grows to in inflation adjusted purchasing power, it grows to more purchasing power than the total money that was made in the working years. And about half of it gets spent in retirement, about half of it gets passed on to heirs. And that's the median amount. So some people see a little more, some people see a little bit less. But that's an amazing truth. Now, you ask the question, well, what would have happened if we just looked at this in nominal terms, just the account balances? So I did that. And you'll see why I don't want to look at these numbers this way. Basically, what it says is that the amount you get to spend in retirement and the amount you pass on to heirs, if you don't adjust for inflation, is about 3 times the total amount you made while you were working. Now, if I was looking at these numbers, I'd say, wow, you're oversaving. It's like, that's ridiculous. I don't have any need to have 3 times as much money in retirement as I had while I was working. But you will actually need 3 times as much money because there's going to be inflation. And so that's why I don't look at it without adjusting for inflation. And the difference in the names for those two things, when we look at the dollars adjusted for inflation, that's a real return or a real balance. And when we look at it, including the inflation, but I'm not adjusting it back to today's dollars, that's nominal returns or nominal balances. So I know this was important to you, Paul. Did we address a question?
I appreciate it. I do think it's important people get that. By the way, those people who did not save, and there are a lot of them. I don't remember the percentage, and I know there are reasons why people don't save, but they basically are counting on Social Security, and there are a lot of people who survive with Social Security. They're not going to have the kind of lifestyle, money-wise, certainly, that the people who save have, but no, I think that's terrific.
Yeah, and I didn't include Social Security here, and it was one of the first comments somebody made on the article. And the biggest reason I didn't is it would be very complicated to figure it out because it depends a lot on how much you make. Somebody who makes more money will be helped less by Social Security in retirement. Somebody who makes less money will be helped more by Social Security in retirement. It will help everyone. It's not that I don't appreciate the program. I think it's a good program to have a way to help increase the financial security of our older population, and it's just it would have made the analysis too complicated. Yeah.
By the way, I have to note, if you think about what's what's going to happen in January, an 8% increase.
Yeah.
Social Security payments. How many people have ever had an 8% raise in their life? That is going to be a big deal. I know the dollars don't buy as much as they used to, but it's going to feel good.
Yeah. Yeah. So I know this sounds too good to be true. And because of that, I did an analysis where I showed in the article how much your contributions are for every decade and how much the investment return is for every decade. So if you look at ages 25 to 35, and by 35 here, I mean the first day of your 35th year, and the first day of your 25th year. So we could have done 25 to 34. You made that comment, but if we look at ages 25 to 35, you make $71,500 in contributions with these assumptions, and you get $23,500 in investment return. Not bad. If you look at ages 35 to 45, and these are all the median real numbers, you make $98,000 in contributions and you get $120,000 in return. That is kind of amazing. In only 20 years, you've gotten to where the return from the investments that you've made is exceeding your new contributions. Ages 45 to 55, still 98,000 in contributions and $300,000 in return. Ages 55 to 65, 98,000 in contributions and $435,000 in return. So by the time you're approaching retirement, your returns are greatly exceeding your contributions. And in fact, one of the milestones a lot of people reach in those later years is their returns start to exceed their income.
The returns here, the median real return, approximately how much is that return? And let me make sure I understand. You went all the way back to 1928 on building this study. So we got the deflationary period in there from the 30s. We've got the Depression. We've got whatever, all those good and bad things that happened over the last 90 plus years. What is that median real return?
Let me hold on a sec. I got to go to a resource. I'm going to pull up my book here, Two Funds for Life.
Two Funds for Life.
And I can look at the appendix where I have the 1928 returns. And I can look at a target date fund. And I can tell you that across a lifetime, so this includes accumulation and withdrawal, your expected median real return dollar weighted was about 5.6%. So in these years approaching retirement, it would be higher. It would be a little bit higher. It's probably, 6 or 7%. And in the earlier years, it might be 7 or 8%. And in the later years, it's going to be, lower. So, yeah.
Okay, so 5.6 is the real. What does that, and I realize again, it's the median number. What does that then convert to nominal? Because I've been
9.8%.
9.8.
9.8. Yeah, this was going back to 1928. Yep.
So what I've been telling people, and I've been giving them a number that's too low. I've been telling people that when you look at a lifetime of target date fund returns, this is during the accumulation period, it's about an 8% average return. What you're saying is it's closer, it's over 9.
Well, keep in mind that that's a dollar weighted return across a lifetime with cash flow assumptions. So if you did a lump sum investment, you'd get a different answer. And I'm not sure whether the number you were using was lump sum. And the other thing is, going back to 1928 versus 1970, you'd get different answers. So, and that's in the book. We could pull that out, but I don't think
that's
we
a great thing. I'm sorry to take you off the
subject. No, that's okay. So the next phase in the chart is retirement, and so from ages 65 to 75, you are taking out $500,000 roughly in withdrawals, and you're getting about a $635,000 return. So in those early years, the target date fund is still a little bit more aggressive, the early years of retirement, enough so that the average retiree is going to see their nest egg grow, which is a great comfort, I think, for a retiree in those first 5 years to be able to live off their investments and have a likelihood that it still grows. That gives them a lot of comfort. From 75 to 85 and 85 to 95, the investment returns and the withdrawals are approximately the same in the median real case. Yeah.
And Chris, just to be sure, I understand the basis for all of this. You are using the Vanguard Target Date Fund glide path, correct?
I'm using that as an allocation, and I'm modeling it as best I can. Yes.
Okay. I mean, obviously, there was no S&P 500 in 1928. I mean, it's you got to use a lot of hypothetical information to build these things.
Right.
But from 65 to 75, just to give a little perspective there, where you're still making more money than you're taking out. During that period of time, what do they go from about 50% equity down to 30% equity?
Yes.
So by 75, it doesn't get any, they don't go any lower than 30% equity. Okay, just to give it perspective.
It actually, I think by 72, they get to the 30%. It's about 7 years after retirement.
Okay.
So the thought that thousands of dollars of contribution per year can amount to millions of dollars of benefit, it sounds unbelievable. But when you look at it decade by decade, looking at the real dollars and the financial returns, you can see how it plays out. And older investors, having lived through this, know that it's true. And it's kind of amazing, but it's true. It's very likely most people across their lives will make more nominal dollars for sure, and even real purchasing power dollars from their investments than they do from their working, which it's kind of an astounding truth for most people. Mm-hmm. So the young investor details, I put them down on this chart, and then I figured out if you take the dollars you get in the real dollars you get in retirement and the real dollars you get in legacy that you pass on, and you divide that by the real dollars that you made in your working years, what is your lifetime purchasing power multiplier? And so for the person who didn't save, the lifetime purchasing power multiplier is 1. You get the purchasing power that you got the day you got your paycheck. For this typical 20-minute automatic sign-up plan, the median lifetime purchasing power multiplier is 2. The bad luck or 10th percentile lifetime purchasing power multiplier was 1.5. So there will be some people who don't double their money, but still 1.5 is a lot better than 1. And the best case scenario, or the 90th percentile, was 2.4. Now we can improve on this, and that's what we'll talk about next, because target date funds have flaws. But yeah, go ahead, Paul.
I want people to know this is right out of the article, so that
yes, if this is right out of the article.
See this, they can. I'm trying to picture all of these 40-year periods that you looked at in the accumulation. And that means some times where inflation was almost non-existent, and the time when inflation was really high. So
yeah, we used every starting month going from 1928 through 2021. Yeah. So when we run out of time, we loop back. So some of the scenarios start in, say, 2020 and then loop back to 1928. And we do that to avoid oversampling the middle years. So it covered a lot of history. Yeah. Hundreds of scenarios.
Yeah. All right. Because, the fact that these are all inflation adjusted. See, one of the things people may not know is there are periods the market didn't do very well, but inflation was low. And there were times the market did beautifully, but inflation was high. And what you've done is you've taken that out of the formula and just shown what did you have in purchasing power, not how did you look in terms of the number you can put on a piece of paper.
Yep, and we will look later at the impact of some changes that we can make on the safe withdrawal rates in retirement too. So this got us to the point of looking at what could you do with the automatic target date fund, but the next question was, could we do better? Because we know the target date fund has a couple of things that we don't like. The first is that the target date fund carries bonds in the early years, which makes it a little more conservative than it really needs to be. It probably costs the young investor about 0.5% per year to have that 10% allocation in bonds over the 40-year period. The other thing is that a target date fund is built of total market funds. And that means there's no meaningful exposure to the small or the value parts of the market. Now, before I go ahead, like how can that be? It owns the small and the value parts of the market. Well, the small part of the market it owns is offset by the large part of the market it owns. The value part of the market it owns is offset by the growth part of the market it owns. The only way you can get some meaningful diversification and potential higher returns from the premiums from those parts of the market is to have disproportionate or overweighted parts of those. So we look at what would happen if you compensate for these shortcomings in a target date fund by adding some small cap value. Before we get to that, though, Paul, you asked again about nominal. So I did throw the nominal numbers on here.
Great.
And again, if we went back and said, I'm just going to go with this default scenario, how much money would you make starting with a salary of $68,000 and increasing with inflation across 40 years? You'd actually make $6.2 million, which is kind of staggering. And how much would you save? You would save with the match from your employer, $737,000, and your investment balance when you get to retirement would be $6.8 million. So somebody who's making $68,000 a year would say, why do I need $6.8 million in retirement? That's just, I'm oversaving. And you'd spend $8.5 million in your retirement years, and you'd end up leaving $11.2 million to your heirs. And again, like, well, why would I leave $11 million to my heirs when I just started retirement with $6.8 million? But when we adjust it all for inflation, what you realize is that you basically end up with a end balance that's roughly equal to what you started with in the median case. And so that means you preserve this nest egg, its real purchasing power, and you can feel more confident about it as you go. Yeah. So, all right. So let's take a look at these ways we could improve. Here's the target date fund. And as I said, we start out here with these 10% allocation to bonds. This is the Vanguard target retirement glide path. And that's what we're going to try and compensate for. And then you can see it's made up of basically total market funds in these early years. So we've got the total international market and the total U.S. market are what it's made up for. So no meaningful allocation to small in value. And so we ask how we can compensate for that.
Yeah, and Chris, just for the people listening, the red area is the U.S. equity, and the yellow area, gold area, whatever it is international. It's about 70% of the equity is typically U.S. and about 30% of the equity is in international. So just to give some perspective to that.
Yep, that's right. and people on the podcast won't see this, so I'll just comment on it. People who observe this closely will notice that as you approach retirement, as you said earlier, Paul, you at retirement you're at a 50% allocation to equities, and about 7 years later you're at about a 30% allocation to equities. And not only do you shift towards bonds, but approaching retirement, they start to bring in treasury, inflation protected bonds, and even some cash to just make it all less volatile and more conservative. And for investors who get into retirement and are comfortable with it and start to feel confident they're going to do okay, they may choose to be less conservative than this. They might decide to either choose a target date fund with a different date, because that would make them more aggressive if they choose a later date, or to hold additional small cap value, or to hold additional equity funds. There's a lot of ways they could adjust. Yeah. So if we're going to compensate here with small cap value, maybe investors won't have access to that in their 401k. So to make it easy, what we'll do is we'll think about two ways to do it where you could add that small cap value in a second fund. And basically the gist of it is we won't require any rebalancing. We'll just say that maybe they open an IRA outside of their employer savings program, and they put some portion of their retirement savings into a U.S. small cap value fund. Now, for somebody with a 401k who has access to a small cap value fund, it's even easier. They just change the default contributions, and they can automate these plans as well. And again, to keep it simple, we've asked that people save 10 pennies out of every dollar in their retirement savings, 10%. What we're going to do is we're going to say, take one of those pennies and put it into the U.S. small cap value. And that'll be the 90-10 strategy here. So 9 pennies go into the target date fund, 1 penny goes into the small cap value fund out of every dollar you make. We'll also look at an 80-20 strategy where you take 8 pennies and you put them into the target date fund, and 2 pennies and you put them into the small cap value fund. What happens to the lifetime purchasing power multipliers using all of the same assumptions we used before? Well, now the median, remember, it was about a factor of 2 multiplier for the target date fund. For the 90-10, it goes to 2.5. The 80-20 goes to 3.3. So the median, that means 50% of people have better and 50% of people have worse experience. The median experience for just taking 2 pennies and putting them in the small cap value fund went from a 2 times lifetime purchasing power multiplier to over a 3 times lifetime purchasing power multiplier. And the bad luck scenarios all got better as well. So the bad luck scenario for the target date fund was 1.5 times. The 90-10 is 1.7 times. And the 80-20 is 2.0 times. So even in the bad luck scenario for the 80-20, you get to double your lifetime spending power, which is that's nice. It's nice to think you might be able to count on it.
Chris, this good luck and bad luck. Let's just talk about the bad luck here. And do you have any memory in looking at the numbers at what kind of part of the history drove the bad luck?
I don't. It's in my book.
Well, I do know this. I know that one of the worst 40 years started in 29. And I think one of the best 40 years started in 1932. So there is so much luck in this process.
The answer would also be different whether you're at the beginning of your career starting accumulation or you're at the beginning of retirement. So for somebody starting accumulation, 1928 was probably a great time.
Yeah.
right? Starting their career, even because that means that the market crash happened when they had no money and they started accumulating wealth when everything was cheap.
Yeah.
And so across their lifetime, it probably played out great. A retiree starting in 1928 gets a double whammy. Their investments all get crushed by the market decline, and then they see, the declining withdrawals that they're going to have to live through because of the opposite of inflation happening for those first years. Yeah,
Thanks.
deflation. Yeah. So I think it's hard for me to see how somebody would have not benefited by one of these strategies. I think the only way it could really hurt you is if you are a market timer and you decide to pursue the 90-10 or the 80-20, and 5 years in, you give up on the strategy. I think that's really the underlying theme for anybody who decides to invest differently is that you really need to stick with it. You should pick something you can live with, you can stick with, you can invest with conviction, because the way you get these premiums is by sticking with these assets through the years when they don't perform.
And an earlier study you did indicated that there is no 20-year period that small cap value underperformed
That's right.
the total market.
But 20 years is a long time.
Yeah.
Yeah, it's a very long time. One of the things I think that helps a young investor, though, is that because of the cash flows, it's really hard for them to know exactly what's happening.
Yeah.
And that's actually a good thing. You've said before that a lot of times a young investor won't know how bad the market is down because they're seeing these new contributions come in and pull it up. Yeah. All right. So I know that in the AAII and also in our podcast audience, not everybody is a young investor. So I wanted to look at what would happen if you took somebody who was age 50 and had never saved a penny. Can we save them? and I went super aggressive and I said, this is somebody who at age 50 gets religion, and they decide that they're going to maximize what they can with their catch-up contributions and everything, and they're going to invest $26,000 a year, including the employer match. So the assumption of a $68,000 salary and a $26,000 a year savings rate for somebody who hasn't saved at all to this point, I'm sure is not realistic. But I still wanted to know, if they got religion and they decided to do everything in their power, would it make the difference? Would it catch them up? And so I modeled this for somebody who retires at age 70. They even work a little bit longer. So instead of retiring at age 65, they retire at age 70, and then they have 25 years instead of 30 years of retirement at a 4% withdrawal rate. And this late start investor doesn't see lifetime purchasing power multipliers that are nearly as big. And they also don't see median withdrawals that are as high. The median withdrawals for the previous scenario were about $48,000 a year. That was the inflation adjusted amount. This late start investor only sees withdrawals of $36,000 a year using that 4% assumption. So that might be a little bit tight. It might be tough for somebody. And their lifetime purchasing power multiplier is only 1.5 times. Now, that's still a lot better than not saving and not starting at the age of 50. But it's not nearly as good. And the reason is there just aren't as many years for the compounding to work for them, or as many dollars for the compounding to work on. So I think the strategy still helps. Now, if we look at what happens for somebody who is a late starter, who does that 90-10 strategy and puts 10% in small cap value, they increase their median real retirement spend dollars to $39,000 from $36,000. So that's good. And their median lifetime purchasing power multiplier went up to 1.6. And for somebody who did the 80-20, they almost get up to that 2 times multiplier. they're at 1.9, and their median real retirement spending dollars went to 41,000. So again, it's just really hard to make up the difference when you start late, but it's a heck of a lot better to start late and do this than to start late and then just rely on Social Security or charity. Yeah. Did you have any questions on this one, Paul, or anything that I went over too fast?
No, it is. I think of all the people I can't think of all of them, but many people I spoke with who were in this predicament. And it is so tough, because when you haven't been an investor for all of those years, the first thing that happens is you tend to get excited about it when the market is up, not when the market is down.
Yep.
And what they need to do is to be excited about when the market is down. So there's certainly a lot of luck in this process, and of course the other thing that we don't know is that during that period of time that they do in starting late, that they do put money away. They do it during a period of time that inflation is low. That could happen. Then they retire, and inflation goes up. They've got a serious. Again, luck is a big part of what your life is going to be like, and the later you wait to start, the more luck plays a bigger and bigger part.
Well, and luck also plays a role in our education as investors. There's people who invest in the stock market and 6 months later are down 30% and sell and then say, I'm never investing in the stock market again. Luck can teach us the wrong lessons. And, that's tough too. Yeah. Well, let's try and end on a more positive note. So I decided to look at somebody who has been a lifetime investor in a target date fund. So they've just followed this simple path and they've gotten to retirement. And then they consider these options in retirement. Like, would it make sense to invest 10% in small cap value or 20% in small cap value? Would it help them? And I also looked at these with withdrawals that I call nudge withdrawals. Just to keep it really simple, I have the investor take their 4% annual withdrawals increasing with inflation out of whichever fund is too big. So these strategies are pretty simple, like the 90-10. You expect to have 10% in the small cap value fund and 90% in the target date fund. Well, if the target date fund is 91%, when you go to take your withdrawal, you just take the 4% out of the target date fund and you let the small cap value ride. And then a year later, maybe the target date fund is 12% instead of it's 10. Well, you just take the 4% out of that. And over time, it just keeps nudging these back to the right allocation. If somebody wanted to do annual rebalancing, I analyzed that in my book. It's not that much of a difference, but I just wanted to keep it simple here. And what we see is that for somebody who just sticks with the target date fund in retirement, between when they retire and when they die, if you take all of the money that they spend, the real dollars they spend, and the real money they leave to heirs, they still double their money within the retirement years, which is kind of amazing. And if you do the 90-10, you get, instead of a 2.3 multiplier for the target date fund, you get a 2.4, and for the 80-20, you get a 2.9. So it helps. But I think the more important thing for a retiree is, what does it do to the safe withdrawal rate? The target date fund in retirement, because it's so conservative, has a safe withdrawal rate of about 3.7%. This is going all the way back to 1928. The 90-10 strategy.
Can you define what is the safe withdrawal rate?
The safe withdrawal rate is the amount of money you could take out starting in year one and increasing with inflation every year, and not run out of money. So the safe withdrawal rate is based on the worst case scenario. What that says is that there was one time somewhere along the way between 1928 and the end of all the scenarios we analyzed, where if you calculated 3.7% of your nest egg in year one and started taking that as a withdrawal, increasing with inflation every year, you ran out of money.
Mm.
There was one time. It's the worst case. So 3.7% is like right at the line. And what that means is that 3.69, you didn't run out of money. 3.71, you did run out of money. So it's right at the line. And like I said, the 90-10, your safe withdrawal rate for 30 years is 4%. And the 80-20, the safe withdrawal rate was 4.4%. And they all had very high survival rates, 99% plus. So I think of the safe withdrawal rate as a measure of resilience to sequence of returns risk. I think Daryl was the first person to draw that observation, and I agree with him. And I think the 80-20 allocation with a higher safe withdrawal rate is particularly interesting for somebody who may have undersaved, because they may find along the way that they have to take out more than 4% occasionally, and they're less likely to run out of money with that 80-20 allocation than they are with 100% target date fund.
So what else, Chris, can we do to increase this final number, the whatever the multiplier is, or however much we take out or leave? What are some simple steps beyond this average, most common 3%, and then going up 1% a year for 7 years? What are the steps you would have people look at?
Well, I'm not sure when that question will come up, but I think you're right, it will come up. I think a lot of investors, especially people approaching retirement and then in their first few years of retirement, it's been described as a red zone. It's a high stress period of time when you're wondering where the money's going to come from and how it's going to work out. But I think as people get confident that they are able to live off their retirement and they are confident in the returns they're getting and they want to take more risk, there are several things they could do. One thing you could do is, let's say you retire in 2040 and you're in the 2040 target date fund, and you start to feel like the allocation is too conservative for you. Yeah, what somebody would do if they wanted to switch the date and switch to a higher equity allocation is they would choose a later date. So they would go from the 2040 to the 2045 fund or to the 2050 fund. You could choose to replace some of the allocation that you have to the target date fund with a total market fund. So there's a lot of different choices. You could choose to manage your bond allocation on your own and just replace the target date fund with a total market fund and a total bond fund. A lot of different ways that people can go. And I believe as people do enter retirement and they get through that red zone and they become comfortable with it, they'll start to figure it out and they'll decide that they do want to do something different. And that's fine. Yeah.
And for the first time investor, I really think this is about getting an education and then having the discipline to do it, that the payoff for investing in the individual funds, which at Vanguard, you can own the same funds, which could include a small cap value fund as well. In some retirement 401k plans, and a lot of 401k plans have a self-directed feature where you could get access to a whole bunch more mutual funds, and self-direct where you could possibly pick up a small cap value. But the idea would be, and Chris, you said it, that 10% fixed income that's from age, let's say 20 to 40 at Vanguard, you get rid of that bond for the first 20 years. You don't need a bond. In fact, bonds hurt your return more than likely over the first 20 years. And then at age 40, if you want to move that money then into a target date fund, you can do that. But I think you'll be way ahead if you get rid of those bonds. Now, I also think that if you do this from age 20 to 40, guess what? You've gotten an education. And it may be that you will be able to address the glide path on your own and have a mix of equity asset classes that will serve you better for the rest of your life. So there are some relatively easy things that people could do to do better. But I think just these basics that you've presented are pretty doggone powerful, Chris. And I know when I say thank you to you for all this work that you do, and it is all on a volunteer basis. I know how many people are appreciative of that. And here's just one more example. So on behalf of all those folks out there, thank you very much for having done this. And your book is available at Amazon. And we don't give it away. People have to pay. It's like $18, or do you remember what it is, Chris?
I wanted to say it was in 1999 or something close to that. I'll double check it while we're talking here.
And every penny that would have gone to Chris, if he wasn't a good guy, is being given to the foundation. So when you buy his book, you are actually helping the foundation further its goals. So
yeah, the book is $9.95 in the Kindle copy and $19.95 in the paper copy. And all the proceeds go to the foundation. And I don't know, someday maybe we'll figure out a way to do a promotional giveaway, Paul, right?
That'd be great. I love it.
I think that would be fun to let people, even if it was just for a limited time, get the PDF for free. That would be awesome.
That's great. Well, Chris, thanks. And we will be back. By the way, we will have that link to the article for people who want to see these tables that Chris has just shared on paper. And by the way, you can try for 1 month, I think, at AAII for $2. You can join and see what they've got. And I will tell you, if you did nothing more than read the rest of the articles that Chris has done there at AAII, I think you'd find them helpful. We've done Rich Buck and I have done a number of articles there, and I really respect their attempt to educate investors, although they get into some areas that we don't, like individual stocks and that type of thing. But generally, there's some great planning information, great asset allocation information. We have lots of friends like Craig Israelson writes there very often. Terrific work. So, all right, thanks. And we'll see you soon.
Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.